κακή ακουστική. Λοιπόν, λέω είναι μεγάλη χαρά που έχουμε μαζί μας τον κύριο Φίλιπ Ammerman, σαν Entrepreneur in Residence, επισκέπτη επιχειρηματία. Αυτός είναι ένας θεσμός που έχουμε ξεκινήσει στο κέντρο επιχειρηματικότητας με στόχο να φέρουμε στην κοινότητα, στο κάμπους, επιχειρηματίες από διάφορους κλάδους, τομείς και εμπειρίες, οι οποίοι μας δίνουν συνήθως μία ομιλία και έχουν κάποιες ώρες γραφείου, στις οποίες οποιοδήποτε θέλει μπορεί να κλείσει ραντεβού και να τους δει για να συζητήσει θέματα ενδιαφέροντος. Είναι ο πρώτος επιχειρηματίας in residence για αυτή τη χρονιά. Έχει ξανάρθει και πέρυσι και τον ευχαριστούμε πάρα πολύ γιατί είναι πάντοτε πολύ πρόθυμος και ένας από τους υποστηρικτές του Κέντρου Επιχειρηματικότητας. Είναι επίσης μέντορας του κέντρου και πιστεύω ότι θα μιλήσει σήμερα για ένα θέμα το οποίο έχει πάρα πολύ ενδιαφέρον και για το οποίο επίσης έχει και πάρα πολύ μεγάλη εμπειρία. Έτσι, γιατί ο κύριος Ammerman έχει τεράστια εμπειρία και σαν σύμβουλος επιχειρήσεων και σαν επιχειρηματίας και σαν επενδυτής. Και καταλαβαίνει, πιστεύω, πάρα πολύ καλά το πώς μπορούμε να αναλύσουμε την αξία, την πραγματική αξία μιας επιχείρησης. Λοιπόν, χωρίς να σας καθυστερήσω άλλο, Philip, welcome. It's a great honor to have you with us. And the floor is yours.
Thank you very much. It's a great honor to be back. The subject today is valuing a startup and negotiating the term sheets around a startup. And what I want to do is present some of the main methodologies used by angel investors and venture capitalists. I think during the course of the presentation we're going to see that the system is based on a very sophisticated understanding of existing investment rounds which have taken place in startups. A lot of these methods come from Silicon Valley, from San Francisco, from areas like the MIT corridor, where not only do investments take place, but the information is public knowledge. If you want to find live examples of investments, there are a couple of sources that I can share with you. One of them is called PitchBook, which you can find online, and you can actually find live examples of valuations, live examples of investments that have taken place, term sheets, and other information. And there'll also be a lot of resources in the presentation. My experience with this comes from two sides. On the one side, I act as a consultant to primarily venture capital funds and investment funds that invest in either startups or mature enterprises. And during the course of my career, I've advised on roughly 120 major projects, delivering about 6 billion euro in investment. The largest tech investment that I've done is one of the startups in San Francisco that has 300 million registered users. I'm happy to say that the principles we use for valuation and evaluation are exactly the same as we would, for instance, evaluate, let's say, a large hotel or a large industry. And they're very common approaches, very common methodologies. And what I want to do is try to share some of these with you and show you some of the pros and cons of each approach. A lot of this is going to be brief. We have a limited amount of time. What I will do, I think, afterwards, I can give you some examples of the actual Excel spreadsheets which have been used. I think that might help you set up your actual valuation exercise. And if you have any other questions, please feel free to send me an email or connect on social media, or we can arrange something for the center. Okay, but again, if you need any more practical advice, we're definitely here to help. So there are always the same questions, whether you are a founder, whether you're an investor, whether you're just someone who is reading the newspaper, or you have a friend who's investing in the sector. And these questions come up over and over again, and really that's what this presentation is about. How much is my startup worth? One step back, I have an idea. How much is my idea worth? I have no prototype, I have no team, whatever. I just have this idea. Is it worth going and doing? A lot of times on the strength of that idea, someone's going to come up and say, sure, I'll back you, 20,000 euro, what type of equity do I get? What share in the business do I get? You need to be in a position to answer that. A lot of times when you're working in a startup, if you're not one of the founders, you're given equity, so stock options, and a lot of times you are wiped out, you're diluted. A new investor comes on board and you lose the value of the options you have. This, again, is a very common recurring feature. It's something you need to be aware of. It's not a lot you can do about it if you're not a founder. And finally, I see any number of people or get any number of calls from people who've received an offer. There's a very big financial price tag on it, but they want a very high share of equity, typically 80% of equity, and then the question is this fair? Should I accept the offer or not? So these are some of the issues we're going to look at. Even if you haven't looked at these issues, I'm sure you've read the news, and I'm sure you get hammered by this information every day. The big story right now in the news is WeWork, the co-working center. They were originally given a valuation of over 60 billion. They wanted to do an IPO of roughly 15 billion. Over the past 2 weeks, there's been a lot of scrutiny of their term sheet and their offering. The price has fallen to 10 billion, and very probably they're going to pull the offer. It probably won't be done. So the question is, is 10 billion, is it a valid price? Should I invest at that price? What do I expect from that? Amazon has been investing in Deliveroo and a number of other companies. Again, you see headlines like this all the time. Or you always, if you read the financial section of a newspaper, you're always getting advice on whether stock is overvalued, whether you should invest in stock, and so on and so forth. The valuation techniques we're going to look at are roughly applicable to each of these situations, with, of course, a lot of relevance to the tech sector. And if you're a founder, yes, yeah, sure.
I cannot hear you very well at the back. Is it okay if we just give you this?
Yeah, sure. Okay. Is that any better? Is it on?
Yeah.
Can you hear me?
We turn up the volume now.
Okay. So, if you're a founder, and to a lesser extent if you're an investor, you're going to answer these questions using a mix of subjective factors and objective factors. The objective factors are the ones that we think are scientific, we believe they're observable, and we believe that in replicating an analysis of the valuation, we would come to the same result. But of course, we're in the tech sector. In the tech sector, a company that delivers pizzas can be valued at €1 billion. That's a subjective valuation, and it's a subjective understanding of what the value produced is. So again, we're focusing this on pre-revenue startups, so startups that don't have necessarily a prototype or don't have a revenue. How are you going to value the startup? Well, with a mix of these factors here. The first is your business plan. You're going to need a financial and operating forecast running to at least 5 years, ideally 7 to 10 years. The minimum is 3 years. You've got to show how you're going to go to market, the amount of funds you're going to ask for, the value you're giving for the funding, and how your company is going to grow. This is entirely up to you. And that is something that we can give you a lot of advice on, but you can also find a lot of advice about this online. The second factor is your team. You need to take certain things into account in terms of the composition of your team. One very obvious thing is you need technical staff, ideally, if you want a higher valuation. And as we will see, if you have some big names on your team, the valuation almost automatically is higher than if you do not. Any other assets you might have, which could be patents, it could be code, it could be methodologies, algorithms, anything else which you have which may not have a tangible value, but maybe has an intangible value and can serve to reinforce your position. And any other information that we can use. Information, say, on your intended markets, on your pricing system, on anything else. So this is all internal. And then you need to be aware that we want a lot of external information. And the first thing that we're going to look at is comparable value. And I know this is difficult to get in Cyprus or Greece, but even in our countries, we have a data set available. So for instance, if you are building the next foodie or the next e-food, right, we want to know if we're going to invest in that, what are the comparable operating factors that you already have? For instance, do you have users? Do you have restaurants? How many deliveries do you do per day? And so on and so forth. What's the average buy or the average ticket per purchase? Something which is going to play a huge issue is the type of investor that you're looking at. Investors fall into two rough categories: smart capital and stupid capital. If you're going for smart capital, you need to be ultra prepared. You need to be, absolutely ready to deal with their questions. If you're looking at The more stupid capital, there's a lot more subjectivity you can use, and we'll see what that means in practice. You've got to know what your investors are actually looking for. The sector is so competitive today that if you go to someone like Metabolon, who I think was here, or if you go to someone like Anderson Horowitz in the States, you've got to know where they've already invested, and that's all a public record. You can find the documentation, and you've got to know what their interests are. If you know what their interests are, the valuation that you can claim is going to be much, much higher. And so it's important to do your research on your investors. And finally, your location. If you're based in Cyprus, you've got to be aware that this is a small market. It's relatively isolated from main trends. And there's a lot of difficulty of getting traction in this market or in regional markets. Of course, there are always exceptions, but in general, this is the rule. And I'll show you some data on just how much valuations have changed in other markets. So be aware, not all of this is scientific. A lot of it is hype. A lot of it is subjective factors that we can talk up. There's nothing wrong with that because, as we say, the buyer has to be there, right? If someone actually agrees to invest, they're going to invest with both of their eyes open. This is a chart which I showed in the last presentation. It correlates the type of investment we're looking at with the finance curve and the growth curve of the startup. This is called the J curve here because it's supposed to look a little bit like a capital letter J, basically. When a startup launches and before it begins earning revenue, it's typically losing money. When it starts gaining revenue, it approaches break-even. This is the break-even point here. Typically what we're looking at here is we're looking at seed capital, which will get our prototype ready, launch in the market, gain traction, if needed, pivot or adapt, and start to grow. But anyone, therefore, asking to invest with you or wanting to invest with you is going to ask you one question. How soon before you start generating money? And how much money are you going to generate? If you don't have an answer to this question, don't approach the investor yet. Take a time out. Talk to friends, try to figure out how fast you can start doing this. Because if you go to an investor, to an angel, without this question, 90% chance the answer is going to be no until you have an answer to that question. We call this the valley of death. Roughly 95 to 97% of startups never make it out of here. They launch, they begin losing money, eventually the investor patience runs out and they close. So this is not this is something serious. Everyone knows this. Everyone in the sector knows this. So really don't take it lightly. When you go to get your seed capital, your first priority is to show how you're going to be climbing out of this and trying to break even and how long it's going to take. The people who we will typically approach in this area are called business angels, or FFF. FFF is one of these many humorous terms that I know: friends, family, and fools. Friends and family support you, fools invest and lose money. But this is typically where the money's coming from at this stage. Once we get to break even, or at least somewhere here as we're approaching break even, we start to look at early stage capital raises. And early stage is typically your Series A round. A Series A round is one where a serious financer comes up and says, I believe in your product, I've looked at your books, I've done my due diligence, I'm going to invest in you to grow. I'm going to invest so that you can move out of here and approach profitability. There is no clear barrier between early stage and late stage. There's not even a clear barrier between a VC and an angel. Everything is mixed up today. But just keep in mind that the larger tickets are going to need a much more greater evidence and a much more greater proof that you're growing and you're gaining traction. After several funding rounds, we typically look at an IPO, an initial public offering, or an onward sale to a strategic investor or anyone like that. But what we're going to be looking at in this presentation is this area here and how we can fund it. So financing stages, seed funding. Typically you're going to get it from people who know you already, that FFF plan. Typically we're looking at something like 20 or 25,000 euro at the very bottom, to up to about 2 million. Again, there's no hard and fast rules, too much or too small. And typically equity is about 20%. Remember, the earlier you are in your path, the less value you have, right? So if you just have a good idea and you approach your rich uncle, he's going to want a higher share of the value if he's going to invest at the very early stage. Series A is typically the first stage with VC firms. The money here is used to expand an existing operation, to take market share, to gain traction, etc. The tickets are much, much larger. I've, again, given a number of roughly from 2 to 15 million. This is a purely hypothetical number. Investors like SoftBank are pumping in 200 million into Series A rounds. That's a sign of how distorted our market has become. Series B is later stage. Typically, again, with venture capital firms, the target is market expansion. We're looking at large tickets, 10 million plus. Debt funding is something you can get once you have a balance sheet and assets. So once a bank can evaluate your credit worthiness, they can give you a loan. The great thing about loans is that there's no equity involved. It's just a loan. You've got to repay it with interest. Mezzanine finance is typically used for the short-term growth debt prior to an IPO. You might find a lot of people running around promising mezzanine funding for startups. It looks very attractive because there's typically low or no collateral offered, so you don't need to guarantee this funding. But again, this is quite dangerous because any mezzanine loans have seniority. In other words, they have to be repaid first in a liquidation. The interest rates are high, and again, it's usually for much greater capital amounts. Finally, we've got IPOs, like the kinds we saw in the slides before. IPOs are typically good when you've really grown, you have a high EBITDA or a high earnings per share, and you can get value from external investors. There's typically a pressure from VCs to do an IPO because it's the best way they can get back their money. So typically, what we're going to be looking at in this presentation is seed funding, possibly Series A funding, depending on what you're looking at. And as I said before, there's smart capital and stupid capital. And if you've had experience in pitching to investors, you should be familiar with this. Smart capital has a formal process, right? You've got to submit a teaser, you sign an NDA, you've got to submit a full business plan, you've got to pitch to a committee of investors, due diligence takes place, and so on and so forth. Smart capital makes their decisions based on data. The more data you give them, the more detail, the higher your chances are of success. Smart capital uses third-party professionals like our firm. They will hire accountants, consultants, technical staff to look at what you're doing and give it an informed opinion of whether this is valid or not. They will challenge you. So they will really want to know what you're thinking or have you proven what you're talking about. They will negotiate very complex term sheets. I've seen term sheets which are 1,000 pages long and more in the sector. So you have to be ready to deal with that. And they will refuse most opportunities. So again, if it's your first time pitching, be very careful if you're going to one of the top angels or venture capital firms. Stupid capital, and I apologize if this is a little bit acerbic, but stupid capital is stupid capital. It makes emotional decisions. FOMO, fear of missing out. Right? If you go to your uncle and you say, I'm the next Uber, your uncle knows or thinks he knows about Uber, and therefore he might be more likely to invest. This capital does not investigate. They accept what you say at face value. They say, okay, you need €1 million, I'm going to come up with €1 million, right? I don't care when you need it, why you need it, are there any alternatives? I'm just going to take it for granted. They don't review the data that you give them. They do not protect their own capital or request a board seat. And typically they follow the crowd. Okay? There's nothing wrong if you have access to stupid capital. Okay? In Cyprus, there are a lot of investors now who you know who are pouring in, trying to get passports. A lot of this is stupid capital. So if you can access that funding, there's a specific way that you can set up the investment so that you have a higher chance of success and that you don't endanger your own interests. Ideally, though, we're trying to work in the mutual interest of the investors and the founders. And I pulled this quickly off Wing. Wing is a company that analyzes deals which are taking place. I've got the quote down here, the source down here, and you'll be able to get this after the presentation. Right now, the average seed capital Series A round, or going from seed capital prior to Series A, in 2010 we were looking at roughly 1.3 million. We're now at about 5.6 million. That shows you just what an arms race exists in this sector. There's a lot of money chasing very few opportunities. So if you're in the right time, at the right place, if before you were thinking of raising 200,000 euro or 300,000 euro, maybe you should raise your sights a little bit more. That also means you might need to look at different countries, different locations, different markets. The average size of a Series A funding round is now 15.7 million, and the average size of a Series B is 30.7 million. We're looking at serious money here. And again, we know from this sector there's going to be a very high failure rate. So a lot of investors prefer to allocate a larger amount of money if it will streamline their own decision-making process and help them go to market sooner. This is something that you can take advantage of if you're in the right place, if you're in the right sector. So before I start with the financial valuations and the methods, I want to just take a step back and talk a little bit about tangible and intangible factors. And again, I'm thinking about startups with no revenue, no prototype, and no money. So we're pre-revenue and we're pre-money. You need to focus on non-financial factors. We can look at positive factors, but we also need to be aware of what the negative factors are. And again, all of this is psychology. So the more you know your business, the more you know your competitors, the more you know your field, the better you're going to do. Let's look at some positive factors. The first is traction, and by traction we mean whatever evidence you can show that your startup is taking off. That could be customer accounts, it could be downloads, it could be installations, it could be trial accounts, whatever. But find some way that you can show traction. The rule of thumb here is that if you've got 1 million customers in the B2C space, that's worth roughly $1 million. Customers does not have to be paying customers. It can be free customers, okay? And again, 1 million is a huge number in Cyprus. It's not a huge number in a lot of other countries. This startup that I mentioned before that we evaluated has 300 million accounts. Only about 20% of those were active accounts. Only about 5% actually generated income. So it is possible, depending on what you're doing, to get a large number of accounts. How can you get traction? Typically by offering either a free trial period or a freemium model. You offer some services for free, enhanced services have to be paid for. You can also do complimentary membership. So if let's say you're doing something oriented towards shoppers, it might not be a bad idea to go to someone like Alpha Mega or I don't know, someone like Zorbas and say, let's set up free accounts for your members. It's a trial period for us, whatever. It's beta testing. It's a service for you. Suddenly you guys go from 0 accounts to maybe 50,000, maybe 150,000. And suddenly you can talk about real traction when you sit down and talk with investors. Besides the absolute number of customers, we're also looking at the customer growth rate, the rate at which new accounts are added. And here, if we talk about scale up in the United States, we're typically looking at something like roughly, possibly 1,000, possibly 10,000 new accounts per day for a B2C company. I'm a little bit embarrassed here because when we launched our first startup, when we invested in our first startup back in 2010, we were approaching VCs saying we're getting 3 to 5 new customers a day. And I can't imagine how many people were laughing at us, where the VCs were. So compare yourself against the biggest in the market. Unfortunately, that's what you have to compare yourself against. And again, if you look at the information on a lot of these services like Spotify or Weebly or whatever, you're going to see a very, very high download rate, which is indicating scale. Investors love it if you can show scale, basically. Another positive factor is reputation. If you have someone with a good track record, if you have a big name, right, on your board or as a co-founder, that's going to automatically probably double your valuation. What's the biggest name you can probably get in Cyprus in this area? Anyone? Brainstorm. Who's the famous Cypriot? EasyJet? Stelios? If you know Stadios, get them on your board, the execs. That's just going to turbocharge what you can ask for when you sit in front of angels or VCs. And typically, you might have to give an equity grant, or you might have to find some way just to tie that person to your founding team. If you were in the scientific field, like so many people here are, and you know any big scientific names in the field who are willing, to back you, get them on board early. I think it's quite common. Prototype. If you have a prototype, your valuation is automatically higher. If you don't have a prototype, again, there's a very high percentage chance that you're going to be rejected. I don't want to put a number on it, but I would assume, at least 80-85% chance someone's going to say no, simply because you cannot demonstrate what you're talking about and what problem you're solving. Now, I know it's difficult to make a prototype, so at least do some mock-ups. Sit down in Photoshop, sit down in PowerPoint, show the investors what the front end interface is going to look at, show them what type of value will be delivered, because that's already going to increase your chances of success. Revenues. Anyone with revenues has a basis to discuss. So again, let's say you're pre-launch, right? Let's say you don't even have a prototype. What can you do to gain revenue? Can you generate advisory income? Can you generate, EU income, project income? Any type of income you show has a very high value, even if it's very, very low as an amount. And finally, if you're in a fashionable industry, you have you add 50% chance minimum to your chances of being funded. Right now, areas like fintech, big data, AI, these are the hottest sectors. There are billions of euros flowing into these every year. So if you're in a sector which is maybe parallel to one of these, or you can incorporate elements of it into your startup, by all means do so, if that's an honest, an honest judgment. There is so much appetite right now for fintech shares in London and in Silicon Valley that you can, you can put lipstick on a pig, and as long as it says fintech, someone is going to want to buy the pig. And why? Clear, right? I mean, banks are losing money. Why? Because we live in a low interest rate world, because property prices are already very high, because equity prices are already very high. So what are people doing? They're trying to invest in something new, like Revolut, like N26, or platforms like this. There's also a huge range of negative factors. And the first negative factor is the industry or sector that you're planning to enter. So if you're trying to enter now into social media, online retail, online tourism, be aware that there's a lot of skepticism. These are very difficult sectors to enter, and people are going to ask you a lot of questions about how you're going to gain market share. Competition. If your competition is entrenched or well-funded, it doesn't matter how good you are. Again, there's going to be a lot of skepticism, or there are even going to be suggestions that, okay, let's fund the prototype and then we sell it very quickly. So if you're competing against Facebook, if you're competing against Uber, good luck. It's quite difficult. The monetization or valorization potential and the amounts is a key issue. You have to prove that the amount of money you're requesting to get to a certain state is logical. For instance, if you say that my cost of customer acquisition is €1,000 per customer, and the lifetime value from that customer is only €300, that means you're losing €700 on every single customer you acquire. So someone's going to say no. If someone is going to say, and why is this a problem? Because if you target the Cypriot market, very likely the costs of getting the prototype out to market are going to be very high based on the immediate income you can try to bring in. Cash burn rate and cash needed. If you're desperate for money, do not tell the investor. That's the last thing you want to say, because as soon as you say that, they're going to start driving down your share of the equity. Prototype complexity and time to market. The shorter the time to market, the better. The longer the time to market, the worse it is. The more complex you have, the more complex the idea you have, the more difficult it is. It's better to break it up into steps. Build, release, adapt. Build, release, adapt. Build, release, adapt. And that will help people make a decision. And finally, your team. Let's say you fly over to Athens and you pitch to someone in Athens, you might be able to get a higher valuation because there's a lot more money available. It's a bigger market. If you fly to London, your valuation will have an extra 0 on the end. And if you fly to San Francisco, you might have 2 extra zeros on the end. And I'm totally not exaggerating. If you go to a VC or an angel here, you might be lucky to get 100,000 euro. In Athens, they have to invest money by a certain date. So you can probably get 1 million. London can be 10 million. San Francisco is probably 100 million. Okay? I'm exaggerating a little bit, but the location you're in plays a huge role. Now, everything until now, as you can tell, is psychological. It's planning. It's how we position ourselves. It's stuff which we can, if you want, we can advise you on. We can give you some practical suggestions. What follows after this is the financial factors. And again, this is subjective. There are different valuation methods here, and I'll point out the strong points and the weak points of them. But this is what you have to present, okay? If you go to an angel and you start pitching, you need to have an explanation for the methodology that you've used to value your startup. And I hope this is where these slides will be useful. So there are several widely accepted methods. There's the venture capital method, the discounted cash flow method, Berkus, scorecard, and so on and so forth. In order to implement any of these, you need your financial forecasts and your operating forecasts. And I'll go through and try to explain each one of these. I think I've tried to give examples. I know this is probably a little bit difficult to understand. What I can try to do is send you some examples of actual spreadsheets later on, showing what the basic calculations would look like. Now, the venture capital method, this is probably the most common form of valuation in this field. It dates back to 1987. It's been revised and updated many, many times. The positive aspect of this is it's also used in many other industries, so it's very, very common. There are 2 steps. The first step is to calculate the terminal value or exit value of your startup. I'll explain that. And then the second step is to calculate the pre-money valuation of your startup. Let's start with the first step. Terminal value is an estimate of how much you could get if you sell 100% of your company after a certain number of years, typically at the end of your financial forecast. The most common way of calculating this is taking a multiple of your EBITDA, your profit, or your sales. Again, depending on what sector you're in and what stage of that profit cycle. Let's say that in year 5, you've got sales turnover of 5 million euro. And let's say that you've got a profit margin of roughly 20%, that's roughly 1 million profit. Your valuation is typically going to reflect the price to earnings ratio in your industry. So let me ask you a simple question. Apple, right? What's its price earnings ratio? How could you find its price earnings ratio? You go to Bloomberg, you go to the Wall Street Journal, you go to Apple, you open the investor area, it's listed there, okay? So Apple has a price earnings ratio of 18. That means that $1 trillion valuation that it has is 18 times its EBITDA, its earnings before interest, taxes, depreciation, amortization. Very simple calculation, widely accepted industry benchmark. You have to come up with this multiple, okay? But you can justify that multiple by simply looking at, like I said, Bloomberg and any other company that's listed and has a valuation that's mentioned there. So if you've got a profit of 1 million and you're taking a multiple of 15 times, your valuation is 15 million euro. Now, what does this mean? This means that if I buy your company at 15 million and I expect that this is stable, this profit, therefore my yield is 1 million divided by 15 million. Okay? So that's what? That's like 4% or something. So the number has a value to an investor which signals the profitability and signals what opportunity they're buying into. This is very, very common. This is what we call the EBITDA multiple. Some companies are using a revenue multiple if they're very early stage. So they'll take like sales. Let's say they have 1 million in sales. They will actually value themselves at 10 times sales, which is optimistic. So the first step is the terminal value. You need an explanation for this. This is the simplest one that we have on offer. And then you need to calculate the pre-money valuation of your startup. That is before someone invests. Okay? Again, there are two ways of doing this. If you have revenue and you have a profit, simply take a multiple and that gives you the valuation. But if you're pre-revenue, you've got to value the work already done plus the expectations of the work, of the return that you're expecting. How do we do that? Let's say that your terminal value is 15 million euro, and we said that that ROI multiple is 15 times, okay? And your revenue raise target is 500,000. You want to take 500,000 off an investor. So what your formula is going to be, the pre-money valuation equals the terminal value divided by ROI less the investment income you're looking at. So in this example, our plan tells us 15 million divided by the 15 times ROI less that investment that we're looking for. That's giving you roughly a 500,000 euro valuation right now. Now, how do you justify a 500,000 euro valuation? Typically by what we call sweat equity, plus whatever other, like we said, tangible or intangible values you have. So for instance, and we'll see this a bit later, but if you've been working for 2 years on your startup and you've put in so many hours of code and you've been doing so many customer interviews and so on and so forth, and you simply take that number of hours times a certain rate per hour, obviously you want to make this as expensive as possible, okay? Your investor will then challenge you, obviously, but if you show this calculation together with your calculation of your own investment to date, then again you've got a higher chance of getting this approved. It's not to say that they're going to accept this, but at least they're going to understand, oh, okay, these guys know what they're talking about. At least they know the basic method of, of trying to understand or estimate how the value is. Now, we had some discussions earlier today on, how you do this forecast and you try to get future value, like how you estimate your future sales. There's basically one rule of thumb. You want the sales to be as high as possible. I know this interjects a lot of subjectivity, a lot of optimism, a lot of exuberance into the process. But if you cannot build a company worth like 100 million, it might be better not even to look at the investment. If your investment is going to give you 1 million euro after 5 years, and your profit is going to get 10% of that, it's not clear that you should be going to a VC. Right? It's not clear you should be going through this process. You can probably crowdfund that, you can probably get it from friends, but if you're in the sector, you have to be in the sector to a large extent. Okay? The money that we saw previously, right? Those amounts, if all you're asking for is 500,000, it means that you're already limiting yourself to what doors you can knock on. Most VCs are not looking at investments below 10 million. So imagine plugging in 10 million here. You understand how big that has to be, and therefore how bold your plan has to be. So again, it's a two-step process. Calculate the exit value or terminal value of where you think you'll be in year 5 or year 7 or year 10. And step 2, calculate based on the ROI and the amount of money you're trying to collect, trying to get a congruence between your pre-money valuation and the work you've actually done. This is not scientific. This is a very biased calculation, but we're in a very biased industry. Key issues here. Your investor has to agree with that valuation. By showing them this, you have the baseline to begin the discussions. Do they agree with it or not? Second of all, if you want a PE ratio, Stern Business School at NYU, every 6 months they crunch the PE for trailing profits, for future reported profits, for pretty much every industry and every sector for the companies listed on the New York Stock Exchange. So if you need a general number, check the numbers that are here. The pre-money valuation is always going to be open to debate. Always. All people are always going to disagree with you. And a lot of investors are not going to want to put the net number. They're going to want to put a reduced number to take into account the losses you have from inflation. I'll show you that in just a bit. If you want to try a startup valuation pre-money calculator, you can look at this link here. You can plug in information and you'll have a valuation basically of your startup. Again, it's very, very subjective, so just be aware of that. Second method is discounted cash flow, DCF. What do you buy when you buy a share of a company? What's a classic definition? You're buying a future revenue stream, right? Which is equivalent to your share of the company. So if I say that today I'm buying Apple, and I look at Apple's numbers and I see, I see like 300 billion sales, sorry, and say 50 billion profits, and I know there's so many shares, and I know the earnings per share. And if I think that Apple's going to keep going into the future, what I'm buying, I'm not, of course in theory I'm buying their patents, I'm buying their products, I'm buying their, their stores, whatever, their inventory, but what I'm really buying is that revenue which comes from the dividends that they pay and from the capital appreciation of their shares. And this is exactly what you are promising an investor with your business plan and with the DCF model or the previous venture capital model. So if you come today and you say, okay, I'm going to invest in a deposit account, I'm going to put €1,000 in there, and I'm getting 5% of that, what interest do you have at the end of the year? You have 5% of 1,000, right? So your deposit plus your interest gives you a new capital that you can then invest. Now, if you do this in the opposite way, you've got to be aware that you're losing money. There's a time value of money. So if you invest €1,000 today, that €1,000 in today's terms has a higher value than it does 5 years from now, right? Because of inflation and because of the opportunity cost of capital. So what the DCF model does is it measures the total sum of cash flows that come from an investment. It reduces these by a discount rate, okay? And it's done over the life of the asset, which includes the terminal value of the asset once you sell it. Again, this might look a little bit weird, but it's explained very clearly on Excel, and there are a lot of examples of the calculation. In this, I have just a very, very brief example. Up here we've got years, going from 2020 to 2026. We have 3 simple indicators: sales, EBITDA, net profit. We assume that we're losing money our first 2 years, we're breaking even from year 3 onward. Our cash flow is here. Again, free cash flow is not EBITDA, right? So free cash flow is EBITDA, less interest costs, less tax costs, which are real costs. We can eliminate depreciation, which is not a cash cost. We've got to account for dividend payments. If we're going to do dividend payments, we've got to account for loan repayments and so on and so forth. But in general, we know how to calculate the free cash flow. So if the terminal value of this investment is 15 million, the discounted cash flow value is the sum of all of these cash flows reduced by a weighted average cost of capital, which in this example I'm putting roughly 10%. Why 10%? 10% sounds really high, right? If you go to the bank, you should be able to borrow from the bank at roughly 3%. Why? Because first of all, the investor has a higher appreciation for their own cost of capital, because they feel that when you adjust for risk, they might get a higher return by investing somewhere else or investing somewhere securely, or there might be a replacement cost of capital, which is very high to get. So if you, again, your whole challenge here, it's not just all of this calculation, which is going to be the result of your business plan and your financial model. You're going to argue with your investor a lot over the weighted average cost of capital. Now in this case, the discounted cash flow value here is only 8 million compared with total cash flow of 17 million. That's very low because the weighted average cost of capital is higher. Okay? If we were to reduce the cost of capital to 5, we'd probably hit somewhere in the midpoint there. This is also equivalent or similar to NPV, net present value. So this is a factor that everyone is going to look at. Every investor is going to perform this calculation. So lay out your spreadsheet accordingly and make sure that you're showing them what that cash flow value is under different scenarios. Another method is the comparables method. And in the comparable method, we basically take the performance of a competing established startup and we measure it against our own. So for instance, if we're starting a ride-sharing application in Cyprus, we would go to Uber, we would go to Lyft, we would open up their annual reports and their IPO listings, we would get the data we need, like the number of rides, the average cost per ride, and so on and so forth, and we would apply that to our startup. This looks extremely simple, and it is. It's very far from being science, but you'd be surprised at how widespread this is in the financial sector. So for instance, typical comparables are total users or daily active users, right? You've probably seen how Facebook lists these. You've probably seen how LinkedIn lists these. This is a main element of the valuation of those companies. So if you're going for somewhere in that space, you probably want to measure things of, for instance, what's our marketing budget per number of daily active users, or what is our valuation in terms of like euro per number of active users. We typically see things like the number of items carried. So for instance, if you're looking at Airbnb, one of their main valuation indicators is how many apartments they have listed, or how many overnight stays they have. We look at revenue multiples, which are, for instance, the price to earnings ratio that we saw previously. We can look at an EBITDA multiple, economic value to EBITDA ratio, and so on and so forth. Let's take a simple example. Let's say that your competing startup has 230,000 users, and they have a valuation of 10 million euro. The value per user is simply that valuation divided by the number of users, that's 43. If your startup has 5,000 users, take the same comparable, take that same multiple, and figure out your current valuation. Okay? It's a simple, foolproof way of buttressing your argument. And everyone is going to ask you this question. Everyone is going to ask to see how you measure up against your competitors. Now, most of you are going to tell me I have no competitors. Fair enough. At least find 2 or 3 indicating, like 2 or 3 companies that are benchmarks in your sector, and measure yourself against them. You're proving to me that you know your business, you're not afraid to compare, and your numbers are rooted in some semblance of reality. Again, these comparables are used all the time. For instance, if we buy a hotel, we're looking at what's the rate per room, right? Or the rate per room night. The Berkus method is based on the historical evaluation of the pool of investments which has taken place in Silicon Valley. It has been defined by one of the leading angel investors and a guy who has syndicated hundreds of investments in startups. So it's very heavily adjusted to the values gained historically in a specific region. The Berkus method is quite simply, if there's a sound idea, that's worth 500,000. If there's a prototype, that's worth another 500,000. If there's a great management team, 500. If there's strategic relationships, 500. And if their product rollout or sales, that's another 500. Now, it's not to say that you just give 500. What you're trying to do is evaluate how you measure your startup, especially against other startups. Again, why is this important to us? If you don't have a valuation which is approaching like this level, or in the future can approach this level once you're up and ready, it's going to be very difficult for a lot of investors to look at you as a viable prospect. Now, am I saying that you're going to use this method? No, not at all. It's just like a reality check. Okay, it's just a method you can use to compare yourself to one of the biggest pools of capital and deal flow which exist. The same approach is taken by something called the scorecard method. And with the scorecard method, we're evaluating a series of indicators, including the strength of the management team, the size of the opportunity, the product or technology, the competitive environment, marketing, sales, the need for additional investment, and any other self-defined factor. So again, these are indicators which VCs and angels use. These are things that we evaluate pretty much in every situation. So how does a scorecard work? you take, this is the range of maximum value, and you try to evaluate your comparison, your status, compared with the benchmark. Right? So are you better or are you worse? If you're better, you're going to be over 100%. If you're worse, you're going to be under 100%. Multiplying this by this gives you the weighted factor. So this example, for instance, we've measured the strength of the entrepreneur as us being 150%, in other words, 50% better than our closest competitor. That results in a factor of 45. We simply multiply those two. If the sample group of other startups has received average seed funding of 2 million, we then take our final weighted factor and we try to justify that we're worth roughly 36% more than that. Again, very primitive, very superficial, but it shows that you've done your research. And it gives you a basis on which you can discuss with investors while sitting around the table. Another method is to take this and expand it into what we call a risk factor method. And we're evaluating 12 factors here. And again, these are 12 factors which are very, very often reviewed. It's the quality of management, the stage of the business cycle you're in, whether there's legislative or political risk, manufacturing risk, sales and marketing risk, funding or capital risk, competition, technology, litigation, international risk, reputational risk, and the potential for a lucrative exit. In this case, we're trying to evaluate on a ratio of +1, +2, 0, -1, or -2. Every net addition is giving us roughly 500,000 euro of value. Now, I know this sounds totally theoretical, but again, we're in a very, very biased sector right now. And if you're not going to be hitting these numbers, you need a very good justification of why you're not hitting numbers like this. This is a score, like this is just a sample ranking. In this case, this has been evaluated so that there's a total of -2, that is $500,000 under the average valuation. So if the average valuation of other startups is 2 million, our valuation implicitly removes 500,000 in value and gives us a new startup funding of 500,000. Sorry, of 1,500,000. Sorry, there's an error there. Okay. Now, some companies look at some risks. So if you go to an investor like Peter Thiel, he has a very specific political risk matrix in his mind that he's going to apply. If you go to someone in Greece and you apply for funding, what's the main risk in Greece?
Taxes.
Yes. So if you want to make sure that you're minimizing that risk, you've got to show that you can get sales outside of Greece, your headquarters can be outside of Greece, right? I mean, there's just a logical response that you go through. But that's exactly right. It's taxes and it's also gaining permission to actually work properly. Okay. Another method is the valuation by stage method. And here, this is probably the core approach which is used. Here, there's one basic principle. If we agree in the previous step that your valuation is, say, 2 million euro, and you're trying to give 50% of equity for 1 million, that 1 million is not going to be released in one tranche. Okay? It's going to be released in phases, subject to you making or meeting certain benchmarks. Now, if you're pre-revenue, pre-money, your business plan might have a valuation of just 20,000 euro. So the investor might say to you, look, once you've got the business plan ready and we agree on it, I'm going to buy 1% of your company and I'm going to give you a valuation of, say, 200 euro for that. You then might say that once the prototype is launched, the value of your company has gone from 20,000 to 200,000. Okay? And then the investor might say, I'm going to now take 5% of that value, which is 10,000. When you get to the first 100,000 users, that might go to 2 million, and so on and so forth. It doesn't matter how you do this. Okay, the point is that if you push the equity versus a higher value later on, overall you should be getting a higher value for the whole business. If you insist on getting all the value in advance, you're probably going to get a lower value. In other words, either lower value of money, or you're going to have to turn over more equity. So think how you can release the payments to your own advantage. The investor is always thinking that way. Why? Because there's so many failures, and they can recognize a failure as it's unfolding. So you might have hit the prototype might have been released, and then you've got no traction, there's no growth. What's going to happen? Will you adapt? Will you pivot? Will you do something else? But if they see that that's not happening, they simply may not release the next tranches, so they might withdraw from the equity investment. A fancy term for scenario planning, so if we're taking the valuation by stages and simply linking it to scenarios, is called the first Chicago method. In this method, we take a worst case, base case, and best case scenario, and we attach a different valuation to the startup under these conditions. I've given a simple example here. Let's say in the worst case, we've got 15,000 users. In the base case, we've got 55,000 users, and in the best case, 100,000 users. I've just put some very preliminary numbers here, which might describe how the startup is working under these different scenarios. You can see that all of these things here wind up to a revenue estimate, and that revenue estimate we would expect to see in the business plan and the operational model. Now, if I just give an enterprise valuation as a multiple of revenue, I have an enterprise value which is wildly different. In the worst case scenario, the enterprise value is only 250,000 euro. In the best case scenario, it's 30 million euro. This divergence is typical in most startups. Very often our plans are optimistic, and we need them to be optimistic in order to get people to take a look at them and to incur the expense of evaluating them. But very often the reality is miserable failure. You know, the environment doesn't respond to what we thought it would do. So it's not a bad idea to combine the valuation by stage with scenarios. Again, it shows you've done your homework, it shows you're prepared. And someone's going to ask you, okay, Philip, let's say that we invest in your startup, and after 1 year you've only gotten that. What are you going to do next? What are you going to do to safeguard our investment, to make sure that this is a success? So you need an answer ready for that. Okay, it's not so important what this is, what the number is, as there's evidence of a logical thought behind it, and an escape hatch, or an adjustment plan. Okay, finally, we can also look at replacement value or cost to duplicate, and this is quite simply, you know, let's say you've built a prototype, you've launched your company. Let's take Foodie, right? Great website, a lot of development hours behind it. The replacement value of this is quite simply the amount of time you would need to do to replicate it with all the mistakes, product iterations, releases, etc., times a certain number of hours for development. Okay? This is the same strategy which is used in real estate. You know, let's say someone comes and says, I want to buy this building. And the university says, well, we don't have any income because we're a non-profit organization, or we don't show profit. You know, how will you value the building? Well, we would value the replacement value. How many square meters? What are the structural characteristics? How many tons of cement? What was spent on furnishings? What would it cost to build that from the beginning? And that's the replacement value. So here, the things that you looked at, the things you would look at are the programming and coding numbers, number one. Cost of customer acquisition. If you've already gained customers, you can put a value on that. The cost of website traffic or engagement, intellectual property costs, and so on and so forth. The problem here, of course, is that this is a backward-looking estimate. It doesn't take into account the future success that you hope to get with this startup. But it's the surest way of taking a reality check on what the value is right now. Okay. And then finally, the book value method. This is the worst of all. For those of you who have any exposure to financial accounting, book value is simply a measure of the value of the tangible assets of the company after you deduct intangible assets, like reputation and things like that, and any liabilities. So in most startups, the net book value is pretty low. We might be talking about 10,000 euro, we might be talking about lower. This is typically used for companies that are about to be liquidated. So if you fail, if you're going to declare bankruptcy, Net book value is an estimate of what people think you can get if you close, and then that value will be recovered by, okay. So how do we really value a company? I'll just give you this, and then I'll give you my gut response. The best methods are going to combine these different methods that we've looked at. It often doesn't matter which method you use, as long as there's a lot of data supporting your viewpoint, and as long as you have a justification for this. There are basically 6 minimum things, and I apologize for this, but it's pretty much unavoidable. The first is the business plan. You need a business plan, and I know that's very often the hardest thing for a founder to do. I know that when you're starting a company and you're at the idea stage, it's extremely difficult to nail down the numbers and to nail down expectations. But sadly, everything starts from this. And I know how often reality is different. I live in that reality. But this is the first thing that someone is going to look at. And they're going to look at not just what you write, they're going to look at the numbers that you use to model your business. So if you're a company like Facebook, right, your business plan is going to say, you know, year 1 we have so many users, in year 2 we have so many users, so many users, so many users. We have this revenue associated with it, we have these costs associated with it, and at some point we're going to hit break even. You need the business plan to be linked to a financial and operating forecast. I apologize because I realize, I don't know if you've seen these things before, but I'll be sure to send you some examples that you can take a look at and you can try to get a feel for the minimum required. The second thing is a team. The business plan and the numbers are on paper or in electronic form. Everything has to be delivered by the team. When we're looking at the team, we need to see that the right experts are there. They're flexible enough to change if needed. For instance, they're flexible enough to relocate if needed. They're flexible enough to change their roles. They're committed and they're ready to fight for the startup. A subset of this is that the tech members are included in the team. It's typically a bad idea to outsource your technical development function. It can be done, but it's typically more challenging. All of these things, the team, the forecast, the business plan, have to solve a real problem in a predictable market. Now, a rule of thumb is that there should be at least 1 billion in revenue in this market. So, what's the market for food delivery in Cyprus? Cyprus GDP is 20 billion. GDP is a measure of value added. If we needed to try to understand how much money people are spending on food, there are ways we can do it. There are rule of thumb, estimates. But we need a big market. If you're doing all of this work and at the end of the day, you're looking at revenue of say 1 million or 2 million, don't be discouraged, that's great. Try to launch the business. But it's not something that many people are going to look at with the intent to fund. At least right now, not in this industry. If you can't get that predictable market in Cyprus, get it somewhere else and make sure you've got that somewhere else. And the final thing is we need a working prototype, ideally with some traction or at least some mock-ups. The valuation methods that we're going to do will be based on the business plan and on the financial model. The money you ask for has to be illustrated by use of funds. What's the money going to be used for? When does it need to be available? How are we sure it's going to be spent properly? So don't ask just for 1 million euro. Ask for, say, 100,000 for advertising, 100,000 for coding hours or something like that, 100,000 for server space. But just make sure it's clear what the money is there for. The valuation that we typically always look at is DCF and comparables based on that business plan. Okay, this is what everyone is looking at right there. We want to see that equity is going to be released in stages. There's almost no way that someone's going to come along and say, take 1 million euro. Right? It's going to be released based on you meeting some milestones. There's going to be a forecast exit plan which shows how fast you generate revenue and how fast an investor can exit, either fully or partially. So remember on that J curve we showed before, on like a Series A funding round, part of the equity that's bought might be from the angel investor in the seed fund. And finally, detailed competitor analysis and valuation. If you don't have this, and you're not ready to discuss it in detail, you're not ready to pitch, okay? A lot of pitching competitions are done purely on the basis of ideas, and then what happens? You sit down in front of an investor and you can't answer his questions. You know, like, okay, you're saying that the value of your company is €1 million, how much money do you want from me, and what shares am I getting for that? If you can't answer that question, and also what the money will be used for, then you probably shouldn't even be doing pitching competitions. I mean, it's great to test reactions and to develop self-confidence, but it's very different from negotiating an investment. There are two great samples, also which I showed in the previous presentation. If you read and understand these two, there's probably nothing else you need to do. Don't go to any more presentations by Philip Ammerman. You know, it's pleasant, but you'll be wasting your time. Just look at these, okay? Everything you need to know is right there. And, you know, you're learning from investing in business when you look there. And there are some online calculators that I pulled out. The simple ones which are free to use are Cedars, Startup Value Online, and Cayenne. Equidam is a company based out of Barcelona. This is one of these companies that consolidates valuation data from thousands of startups that have been funded in Europe. You need to register. You'll have limited access to their data. But if we want European level valuation, this is probably the best source. These other ones are very, very good. You can plug the numbers in. From the methods that I've shown you, I think you can try to understand the methodologies that are being used. And if nothing else, you can rerun the valuations using different numbers to see how the calculators perform. But what you really need is your own model, okay? Your own sales, growth, revenue, expenditure, so on and so forth. Okay, term sheets. I'm going to go really quickly through here. Is that okay? And then we'll do some questions and answers. So the term sheet is the complement to the valuation. Up until now, we've tried to develop a dollar or euro amount of how much our idea is worth. The term sheet is going to tell us how the equity is valued, how that equity will be distributed, decision-making rights associated with it, governance, and how the future breakup of the company will work. A term sheet is basically an integral part of your investment. When an investment negotiation takes place, the investor does due diligence. They're going to look at your code, they will look at your idea, they will look at your pricing, everything else, your business plan, your team. They will negotiate with you the terms under which they will invest, and they will grow the company with you. And these things together translate into a legal documentation, which is the subscriber agreement or the subscription agreement, in other words, the terms under which they will invest, and the new statutes or articles of association. So the term sheet is non-binding. Under a term sheet, this is typically being revised continually as the due diligence takes place, and it just outlines what the terms of the investment will be. Now, I know all this sounds a little bit theoretical, but if you make a mistake at the term sheet stage, and this contract is drafted, and the articles of association are drafted, and 6 months later you disagree with them, you don't have much legal power to prevent to make a change. Okay? So I know this might be a little bit boring, but this is absolutely key. It's more important than the valuation. Yeah? The valuation is not money in your pocket. It's money which will be given as time goes on, and that money has to be spent to grow the company. So if you disagree with your investors on key issues, and they seize the company from you, or they bring in new investors and they dilute you, and they eventually replace you, this is your fault. Because you've got to pay attention to this. And it's the least glamorous, it's the most boring part of the process, and it's the most important one. There are 10 components, and I'll just run through these as quickly as possible. So the first part is the pre and the post money valuation. What this does is it takes the valuation methods that we discussed before, it takes the number that you've agreed upon, and it pulls that into the term sheet. It says very clearly, as of September 19th or whatever, September 17th, we value Philips company at 1 million euro. We are going to, that's the pre-money valuation. We will contribute, say, 500,000 euro for a 50% share. Therefore, the post-money valuation is 1,500,000 euro. Okay? So this is the common basis between the funds and the shareholders for the current value and the future value of the company. Your term sheet is going to contain a capitalization table, a table of capital. How much capital is given to different people and different entities. So if you're 2 founders and 1 investor, there will be 3 lines in that capital sheet. If there are 2 founders, 2 investors, and maybe 5 staff that you're going to be giving share options to, those all have to be written out in this capitalization sheet. There's also going to be different types of shares. There's common stock, there's preferred stock, there's restricted stock. All of that has to be defined, and I'll show you what it means, but just be aware that all of this has to be documented very, very clearly. And at the bottom of this, we're going to have a percent of ownership. That percent of ownership is per person and per type of share which is used. There are resources for this later. I know this looks a little bit general, but in the presentation there's a lot of examples of how you can calculate this and structure it. So the shares, besides that share of profit, they give you a share in the decision-making power of the company. And this is what we're interested in. The profit is interesting, of course, but it's only interesting if you can get it and if you're able to maintain it. So within our voting rights, we're going to we have to list the type of shares available and who has which shares, which category of shares, and what rights each share gives you. Typically, we've got common stock, which is partial ownership and right to profit. We have preferred stock, that's also called Class A shares. And the Class A shares are the ones which give you typically a greater role in decision making. One of the reasons the WeWork IPO is failing is because the founder, a German guy, has a much higher number of preferred shares than his equity share would indicate. So for instance, investors are being called to put up 50% of equity. They're getting only about 15% of voting rights. And this is just not on. One of the big complaints about Mark Zuckerberg at Facebook is that he has too high a number of preferred shares. So if you're worried about maintaining control of your startup, just make sure you've got, you can give 50% of common shares, but you can keep 75% or something like that of the preferred shares. Convertible preferred stock is preferred shares which can convert to common stock, typically at a predefined ratio. Stock options are the right to purchase shares at a predefined value. You're typically giving those to employees or people that you need to keep on board. Restricted stock are shares issued which prevent certain activities. The longer you hold on to those shares, the more those restrictions fall away. Participating preferred stock are shares issued at a predefined listing price which can be converted to shares at the request of a shareholder. And warrants are the right to purchase a certain number of shares at a predefined price. This may seem very complicated. The reality is far more complicated. And unless you've really defined these things, if you're confronted with a term sheet which has these terms, you need to be absolutely sure you understand why and under what condition these different points take effect. You guys are all too young to remember the 1999 stock market crash. But one of the big issues is when companies listed, they did their IPOs here in Cyprus on the stock exchange. They didn't pay attention to this. And a lot of founders were they had their companies taken away from them by the banks that ran the IPO and that invested. So it's really important to understand these things. Reserve matters are matters that can only be solved with the express agreement of a large majority of shareholders or a certain category of shareholders. Typically here are the appointment of key officers, like a chief marketing officer, chief financial officer, entry of new investors, approval of annual accounts, and so on and so forth. This gives you
and the investor an added measure of security over how the company is managed. Governance, board of directors, key officers. The board of directors are suddenly very important in the startup. When you're founders and you're trying to develop and launch, you're typically, 3 people in a room working very long hours. You make all the decisions by yourself. As soon as you get investors, you have the board of directors over you. And that means you have to take reporting seriously. The board of directors has legal authority to approve accounts, appoint auditors. They can remove certain people from their posts. There's just a series of points under Cypriot law and also under international law that they're going to look at, and any investor is going to maximize their access to the board of directors. Liquidation preference is who gets priority to cash when the company is liquidated. Typically, lenders come first, shareholders come last. So if you've got mezzanine capital or mezzanine finance, they have typically first right on any money from liquidation. Then it's the ordinary lenders. Then it's typically external investors, preferred stock shareholders, common stock shareholders, and the stock options are last, which means if you've been working in a startup and you've been waiting for stock options and you've been wanting to convert those and the company goes bust, you've lost everything, basically, typically everything. The employee stock option plans are typically seen in most startups. Founders typically get preferred and common shares. Employees typically get common shares. Typically, these options vest over 4 years. That means they are gained over 4 years, not over 1 year. They can be tied to duration or performance. In a seed round, typically 10 to 25% of equity is given this way. So there's a specific provision for the employees. And whenever there's a further investment round, it's typically these shares are diluted first, so they lose their value because new capital comes into the company. Vesting schedule. This is the schedule by which stock options can be claimed or shares can be sold. Founders typically have an upfront vesting schedule, so if there's a stock award, they take this immediately. Employees typically have a 4 to 5 year term. And if you're giving stock to consultants, directors, advisors, this is typically based on a fixed term contract or on a milestone or deliverable basis. So I'm just going really quickly. We can, if you need advice on any of this stuff, we can look at it later. Dilution occurs whenever new investors come on board, right? So if you are bringing new investors, the capital will be available. The value of your company goes up, but the amount that you keep in terms of shares or in terms of ownership goes down. So just be aware of that when you're planning your capitalization table and any new investment rounds. I have some resources here. Capitable has a complete table for capitalization that you can use. So if you want to see how to do this exactly right, just create a demo account here. And you can plug in anything you want over time. You can model different funding rounds, and you'll have a very good understanding of how your ownership is going over time. Very quickly, today we've got almost unlimited capital available for growth. The money is there. It's seeking an outlet. That money cannot stay in government bonds because government bonds are too low. It cannot stay in deposit accounts because of negative interest rates. Property is overvalued right now. Most shares are overvalued. There is literally unlimited firepower for startups. Okay, and unless we have a massive equity crash and correction, this is probably set to continue. Now, we talked about what you need. You need your business plan, you need your idea, it's going to solve real problems, you need a founder team, and so on and so forth. But the key lesson is you have to master the details. If you haven't expressed these details in your documentation, and if you're not ready to negotiate the details in this process, you're going to get shafted. Either you won't get funded, or you'll get taken advantage of during the funding round and during the negotiations. So none of this is romantic, right? What's romantic is building a machine to save the world, or building an Uber or something like this. But the devil is in the details. And the greater the command you have of these things, the faster you're going to get funded, the better valuation that you're going to get, and therefore the better chance of survival, we hope, you'll have going forward. None of this is easy, but there are a lot of resources available as I've outlined out there. The final thing is the location. Cyprus is a beautiful country. I love it here, but this is a difficult country for startups. It's difficult to get people to buy from a startup. It's difficult to go online. It's difficult when the physical distances are very small and the markets are small. So if you're doing your plan based in Cyprus, just be aware, you're probably inputting a valuation discount into your plan. Okay? And I'm not saying you should go crazy. I'm not saying you should, house your startup in a penthouse apartment in Manhattan and drink champagne every day. But the markets are just bigger and more liquid in these other countries, and there's a huge mix of capital available. I mean, we've seen deals take place when someone flies in for the weekend and they say, I've got 10 million euros sitting in my bank account and I want to allocate it by Monday. Now, it's not going to be transferred by Monday, but by Monday there's going to be an agreement in principle, and then, people start working on the valuation, the due diligence, and things like this. A good idea and a good team are going to be funded. And you can take pride in that, and you should work towards that effect, because the work you're doing should be valuable enough to make a difference. It's just that it might take 6 to 8 months to get a deal done here, and the valuation, like I said, it might be 100,000 euro. If you were to do this in another city, it might go very, very quickly. You'll have a great chance of success, and you'll get a great evaluation for your company. Paying attention to details. It's the most important advice I can give. There are multiple sources of information, and if any of you want to actually live this in practice, there's a fantastic accelerator out in San Francisco called Y Combinator. They take a lot of international teams. It's a 3-month commitment, and when you're there, you're going to learn everything, and you're going to come into contact with other founder teams and with a lot of investors. So if you want to short-circuit the process, maybe think about going there. There's also lots of other funds. There's some great funds being set up in Greece and operating in Greece. So you can learn a lot from them, basically. All of the information that I've talked about today is online under various sources, and all of the valuations are also online. I'll send out some sources for that. If you have any questions going forward, after the session, please feel free to email me or to connect on LinkedIn. If you don't find me, because I'm traveling a lot, make Oresti suffer. He's a nice guy. Oresti, do you want to introduce yourself? One of the consultants from Limassol is Orestis, and he's handling a lot of the work here in Cyprus. So thank you very much. We'll distribute the slides, and if there are any questions, we have time, I guess.